Hey, what's up everybody? Jeff Beers here from the 40 Finance channel. Today I've got my top ETF picks to buy into during the stock market correction. In my opinion, these are great ETFs to start seeing quicker returns when things bounce back. So let's jump in. And don't forget, if you like stock market analysis and personal finance videos, then please subscribe to the 40 Finance channel. Thank you to everyone for your support so far. All right, ETF number one on the board is the iShares US Consumer Services, ticker symbol IYC. And I love this ETF because it has everything to do with consumer discretionary spending, right? These are the first things to get hit hard in a recession. They're also the things that typically dig America out of a recession. After the flood of coronavirus news last week, this ETF dropped from about $245 at its high. It's now down to $208. And if we continue to see more downside in the market, then it could drop even lower. As it stands right now at $208, you're basically getting in the same as an investor who got in like last April. So you're basically getting a whole year's worth of discount in the IYC. It's a low-cost ETF with an expense ratio of 0.42. And it does have a yield just under 1%. All right, taking a look at some of the holdings of the IYC, this is a market cap weighted ETF, and that means the bigger the stock from the market cap size, the more of a percentage held that you're going to see in here. I like market cap weighted ETFs, mainly because as one or two things start to grow, they get picked up on very quickly with a market cap weighted ETF. And on the same token, they adjust well as other companies take in those top spots. So if Amazon, for example, would fall from the top slot for some reason, but we saw that Home Depot was making huge gains in the market, over time, Home Depot would overtake Amazon in this ETF, which is exactly where you want to be, betting on the winners and slowly getting out of the losers. Okay, from a holdings perspective, Amazon leads the way at 9.88%, followed by Home Depot, Walt Disney, Netflix, Comcast, Walmart, McDonald's, Starbucks, TJX, Booking Holdings, and Target. Basically, anywhere the consumer is spending discretionary dollars, this ETF is going to have a piece of the action. So if you're saying to yourself, I don't have a ton of money to get in on this correction, something like the IYC is a great way to come in and get exposure to literally hundreds of great companies at a small entry price of just about $200. And as a couple bonuses, it has a low management fee and it has a dividend as well. Okay, looking at the performance of IYC versus the S&P, this chart that I put together here with Yahoo Finance is a 10-year chart, March 1st, 2010, January 2020. From that time frame, if you had one share of each, IYC is up 241%. and S&P is up 152%. So what we know about the last 10 years is that the consumer has significantly carried the economy. So consumer spending, right? And that's why I love to have a percentage of my portfolio in IYC, because frankly, it's just a safe haven. Anytime consumer spending and credit tank, yes, these companies will go down as well, but the whole market will go down. And so you're not really losing more than the market in a situation like this when you're banking on consumer spending. And furthermore, when the market is down and you're looking for a bounce back, guys, 90% of the time, it will be consumer spending that pulls the market out of a recession or a pullback or something like that. So in my personal opinion, IYC is a great place for a portion of your portfolio. It's a buy and hold forever, exposure to lots of great companies. Make sure you do your research, but give it a look. All right, next on the board today is the Invesco QQQ Trust, and this basically exemplifies the top 100 companies in the NASDAQ exchange. And if you don't know the difference between all the exchanges, the super quick version is the NASDAQ is known mainly for its technology and forward-thinking companies. And what you have seen over, give or take this last 20 years is that NASDAQ stocks as a whole have outperformed the other indexes quite substantially because they're rooted in technology and advancement. And of course, the world is changing so much every day. And all of that change comes from technology and advancement. QQQ today, very similar to the IYC. So it's got a stock price of $205. That is off the high of 237. And today, if you got in, you'd basically be saving yourself 5 months of an upward swing that investors saw who got in, let's say in September. So you get all of that time back to place some bets on the QQQ. This is another buy and hold it forever, don't sell, and you will see returns. All right, similar to the IYC, this is a market cap weighted ETF. So at the top of the list right now, we have Facebook at 4.24%, followed by both versions of Google, Comcast, Netflix, T-Mobile, just to name a few. You also get international exposure. You've got Baidu on here. At the bottom of the screen, you see JD.com and Mercado Libre. And if you really stare at this list, you see that it also has a pretty strong consumer spending type orientation to it, right? When you think about Netflix and T-Mobile and Tesla and Starbucks and Marriott, those are all companies whose success is rooted in consumer spending. So when consumer spending goes down, yes, the downside is these stocks will go down as well. The bright side is it's consumer spending that has the highest correlation to a strong economy. So as soon as that picks up again, you are going to see returns. It is very unlikely that we would ever see a world where the consumer does not spend on goods and services, right? Because that is what the economy is. So riding in here with the very best of the best gives you the maximum exposure to companies that are doing the most with consumers and technology all in one ETF. All right, looking at the historical performance versus the S&P 500 since 2010. And what you'll see with QQQ is it's outperformed even the IYC. IYC was up 250% or so on this chart. Same time period for QQQ, you're up 350%. That's versus a benchmark of the S&P 500 at 152%. So again, you're staying focused on where the trends are happening. You're not getting dragged down by commodities businesses, right? Like steel and oil and things that just have had trouble moving the needle. You're into the world of active achievement, companies that are using advancements to go forward and grow, and that's what I love about the QQQ. All right, last on my list is one of my top favorites, and that is the FDN, First Dow Jones Internet Trust. It has not had the same one-year performance as the other two we've talked about. However, when we get into the names, you'll understand why this ETF has the most potential to bounce back quickly. ETF price right now is at 137.40. That's off of a high of 155.84. That puts you back to about September when we think about this most recent correction in the market. It also features a low expense ratio of 0.52%. There is no yield with this one, and it is also market cap weighted. So let's take a look at some of the holdings. All right, the key for classification with FDN stock holdings is they have to sort of be internet powered, if you will. So it's sort of an internet commerce play. I wouldn't say 100% e-commerce. I would just say that the businesses on here derive most of their revenue from internet ventures, and that's what we track. So at the top of the list, no surprise, is Amazon at 9.22%, Facebook, Netflix. Those have all been sort of consistent names across all three of these. Then you start to get into real internet specific companies, right? Software as a service companies like Salesforce, Cisco Systems, PayPal, one of my favorites, Twitter, eBay, Okta, which is a cybersecurity firm, Akamai Technologies helps to run servers and websites, GoDaddy, DocuSign, Etsy, E-Trade, TD Ameritrade, HubSpot. These are all companies, if you're thinking sort of about like cloud-based revenue, right? Like they don't necessarily sell cloud services, but a lot of their operation is hosted in the cloud. A lot of what they're offering consumers is an opportunity to take advantage of cloud access points. And to me, this is just where the future goes. There's no concerns on this list about retail closures. Very little concern on this list about financials and commodities and things like that. It's just straight internet technology that we all know is going to grow more prevalent beyond what it already has. This is exactly for myself and my portfolio. These are exactly the companies I want to have represented by my money. Okay, looking at the 10-year comparison versus the S&P 500, FDN is the winner of the three ETFs we featured here. So it's had an up and down little bit to this past 12 months. However, when you look at the past 10 years, FDN brings home a 441% return. I believe that our IYC was in the 250s and QQQ was in the 350s. So another plus 100%. FDN is still wobbled a little bit since that December 2018 correction that we saw at the end of the year. It's still finding its like upward trajectory from that point period. And obviously we've had the setback here recently. And for me, I'm just investing more. I'm just continue to build a position in here. And the key for an investor like myself is just I believe in what this ETF represents as far as businesses going forward. Okay, so those are my three ETF picks to help any investor make a couple bucks off of this downturn. I wanted to share real quickly though, because a couple of people have asked, what my overall holdings are. And without getting into specifics, but thinking about a broad picture, my goal, it comes in chunks here and there, but my goal is to hold basically 50% ETFs and 50% individual stocks. So depending on the time of year and the prices, I'm building up that core foundation of ETF exposure, mostly from some of the names that I displayed here today. And then on the other 50%, I take my chances with individual stock buys, which are obviously much more risky. But I do want my hold forever ETF foundation set. And right now it stands at 30% FDN, then I have 13% in the IYC, and that 13% is going to be something I'm actually focusing on this recent correction. I want to build that up more while it's at the price it is. And lastly, on the ETF side of things, I have 15% in what is the ARK Investments ARK W, which I think they call like their Web 2.0 investment fund. That's a managed ETFs, so the fees are a little bit higher. It kind of takes the principles of the FDN, where you have internet connected businesses, but I would say it's slightly riskier. They have like heavier plays on companies like Square and Tesla and folks that are making gigantic changes in the internet commerce area. However, I do like it as sort of a more aggressive play. So if I could reset my board, which, you know, will happen over time, but it's just a matter of me buying strategically to balance it out more, I would have 25% FDN, IYC at 20%, and ARKW at 5%. So that would be my 50% in ETFs. And the other 50% would be miscellaneous stock holdings as I see buying opportunities. All right, guys, so hope you guys enjoyed these ETF picks. Do your own research, see if they might be a match for you. It's a great way to get into the market, especially right now, without having to buy a lot of companies and spend a lot of money. Let me know what you think in the comments. We'll see you on the next video.